Hi, wish you all a very happy Diwali and a prosperous new year. I'm Devang, and in this video, I will take you through a summary of macro events for the month of October 24, the impact of that on fixed income markets, strategy for our portfolios, outlook for fixed income markets, risk to the view and opportunities for the investors. To start with the macro events for the month of October, the highlight for the month has been the change in the monetary policy stance by RBI MPC members. We believe that they got comfortable on the CPI trajectory. Also, the Fed cut of 50 basis and the good monsoon helped them to overlook the hump in the near term and the uptick in inflation, plus they changed the monetary policy stance. The CPI for the month of September came a tad higher at 5.49, much higher than market expectations. It was led by base effects and rising vegetable price momentum. We also expect the October print, which will get released next month, would be higher at around 5.75, but we expect headline CPI to be back in the 4.5% range post-November and don't expect any changes in the full year CPI projections. Banking liquidity in India continued to remain positive, and government buyback announced of 50,000 crores plus the slower credit growth has helped the money market yields to remain stable. It's important to note that incremental credit deposit ratio year to date is less than 60%, and we believe that the banking liquidity for the quarter would remain comfortable. Bond market yields both in India and US have actually seen an uptick in the last 30 days. US yields, the 10-year bond yields, are up by 50 basis from the rate cut, and Indian 10-year bond yields are now up by 10 basis from bottom. Interesting question to ask is why yields are up despite a Fed rate cut of 50 basis, RBI stance change, and easy banking liquidity. We believe the major reason for uptick in US yields is due to the increased probabilities of Trump getting elected, which can lead to higher US fiscal and higher inflation in US in the near term, which will lead to the delay in the Fed cuts. Even if Trump gets elected, we believe US economy at the margin is slowing, and analyzing the macro environment, we expect Fed to deliver 50 basis of cut in this year and around 100 basis of cut next year. Our perspective is that US Treasury futures are now not pricing in aggressive rate cuts. Hence, the sell-off in US yields is largely overdone, and our expectation is US yields should now soften going ahead. Another important reason for the sell-off in bond market yields has been China's recently announced stimulus package of 4 trillion yuan. It's approximately $600 billion to boost the economy, which can lead to uptick in crude and other commodity prices. I think the measures announced are of significant magnitude, but it's too early to conclude their execution, the impact of that on global macros, inflation and commodities. Keeping all the macro environment in consideration, we believe that with the stance change, RBI has already pivoted, and our expectation is that RBI will be delivering a 50 basis rate cut in the next 6 months. Accordingly, it's important to assess what's the strategy of our portfolio and outlook for markets. We have been maintaining a higher duration across all our funds and guiding for rally in bonds since March 2024. We've already seen a rally of more than 40 basis in 10-year bond yields since the beginning of the year. But the continued positive demand supply dynamics for government bonds and the expected rate cuts will continue to keep bond markets happy, and we expect another 25-30 basis of rally in the next 3 to 6 months. We believe that the banking liquidity also would continue to remain positive in this quarter and expect money market yields to remain stable. Due to favorable demand supply dynamics, we continue to have a higher bias towards government bonds as a part of our portfolio strategy. As India's growth remains strong, we do not expect RBI to be aggressive in our cutting rates, and our view continues to remain that we see 50 basis of rate cuts till March, April 2025. It is also important to understand the risk to the view. We see two big risks to our long duration view. First, US elections. Trump getting elected can lead to volatility in the bond market yields in the near term, as it can lead to higher US bond yields due to fiscal expansion and higher inflation. The second big risk is the recent measures taken by the Chinese government, as they can break the disinflation cycle and can lead to higher commodity prices, which in turn can impact both INR and bond yields. In this environment, so then what should investors do and what are the opportunities lying ahead? Our belief is investors should continue to hold duration across their portfolios. Incremental gain in long bonds would be in anticipation of rate cuts. We believe 50 basis of rate cuts can lead to more gains in bond markets. In line with our macro view, we continue to advise short to medium term funds with some tactical allocation to gilt funds to our clients. I would request everyone to keep watching this space every month for our fixed income outlook from Axis Mutual Fund. Wishing you all a very happy Diwali and a prosperous new year.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.